Hello everyone, it's me the Boss Hog. Sorry I've not been with you for a few weeks. Got some sad news in that my pet passed away and I just wasn't really mentally in the right space. Last weekend I was also with my sisters for a bit of family time, but I'm back now. We're going to do a bit of an update, tell you what's been going on and go from there. Let's do it. Alright, a very short-haired Boss Hog this week as well. Yeah, first of all, for anyone who's really noticed, you might notice that despite the fact that over the last 3 weeks we're down about 5,500, if you look at my thumbnails, they've gone from sort of being +5 down to -3, and you might think the math there is definitely wrong. I also realised exactly the same thing when I was doing this catch-up and actually discovered a bit of a gap with my carryover from a previous month. So sorry about that. It's a bit of an update. I just made a mistake basically in my spreadsheet that I used to bring together the 3 different portfolios that I have. Without further ado then, so yeah, a few weeks to catch up on. Broadly speaking, it's been a difficult few weeks. I am still technically outperforming the S&P both over the last few months and since I started. That's not like every month, but over the last 6 months I've been running ahead of the S&P, despite getting quite beaten up by the Russian invasion of Ukraine. I am underperforming the FTSE 350, which is the other index I measure against. And again, that's mainly because of my portfolio makeup. I have some tech and a fair chunk of it, but I don't have any of the commodities that's been quite beneficial to the fact that the FTSE is outperforming many indexes this year. So that's the explanation for that. Don't think it's anything to do with my amazing stock picking or anything. And I'm broadly speaking just riding the market variances at the moment as best as I can. So pretty brutal few weeks. That said, I have started to add capital again. I've had an expensive couple of months, but my wife's got a new job. We're in the process of remortgaging. Pet insurance came in, so a few things that we had are starting to work themselves out. I will be putting in more money this month, but I expect it to be toward the end of the month, just to make sure that with costs going up, we're expecting an electricity bill, those kind of things, just making sure that we don't run out of money mid-month, basically. So. Yeah, but 800 again this week, so we remain 5 days ahead of schedule, so that's an important thing for me. I will touch on it in a second. I'm continuing to build positions in 8 new ETFs. Technically this week, I now have 9 ETFs in total. One of them I had from before I started opening up ETF positions. So I did actually add to that existing one, and we'll talk about it more in a bit. But yeah, so there was one ETF I didn't add to this week that I have been building a stake in for reasons that I'll highlight. And actually, I mean, all of these dividends came in a few weeks ago now, but I just wanted to update on them. Nothing major. These were my last 3 for August, even though they're in the middle of August. As I touched on, I think in my last video, August is a very poor dividend month for me, whereas September is a really good one, just because we start moving into the UK dividend period, which typically is twice a year. And September is a really good month for me. I have a couple of very big, 3-figure dividends, and in a single month, it's about 0.5% of my portfolio. So obviously, not every month I'd be having that, or else I'd be yielding about 6% a year, which would be nice, but it's definitely not what's happening. So that's going to be really good for me, and we'll touch on those dividends as and when they come. But I'm definitely looking forward to it. Anyway, let's have a look at my buys now. Alright, so this is the full breakdown. I'm going to start referring to this as my 9 ETFs, which is how many I have. It's just like I say, 8 of them are new positions. The one that I had this week was SMT. Now, I had a smallish position in SMT before, about 650 quid before this extra 100, so only about just over 0.5%. I am in the process of averaging down. My buy price was an average of £10.80. Now it's at 10.48. So I over the next few months, I expect that to get underneath 100. And really, I was kind of holding off buying into more tech ETFs because again, I have about 35% of my portfolio in tech already, excluding SMT. But actually, the tech sector is getting quite beaten up. SMT, I'm down. Obviously, you can see it quite materially, considering I'm buying these shares at 7.91. And W cost here, which is like a consumer staple ETF. It's probably my least favorite ETF, but I feel like I should have exposure into that area, and I don't have any others. It's actually still green, and I just didn't really want to be buying stuff and averaging up when I was sitting on like a 20% red on SMT. So I decided to pivot slightly and just grow my share there, and hopefully pick up a better time to buy more W costs, which is already it's already trading on like a 20 PE because of its attractive defensiveness at the moment. So that was my my thinking there. The bottom three here, I've just reinvested the dividends. I still like all of these. EPD, I think, is really safe, conservatively run gas line company. ASML, Dutch, builds scaffolding for chips effectively. Is a snapshot of how I take that. I think it's quite an expensive stock, but actually I think it's got a huge potential in the future. And Elixir here, one of the more spicy investments that I've got, but it's a small, profitable, basically a management consultancy company, very small UK listed company, but I like it. It's already profitable and starting to pay a very small dividend, but it's nice to see that. I'm quite optimistic for it for the future. It's definitely a bit of a punt, but actually, maybe I shouldn't say that because I like the company, and so yeah, although it's one of my smaller caps, I think it's got a lot of potential to grow a bit bigger. So those are my buys this week, not too exotic. And again, we are going to look at my portfolio next because there are no sales to touch on, again, where I'm just not selling too much at the moment. All right, so you can see there's been a few weeks since I last basically saved my portfolio. So I take a portfolio snapshot once a week. It's pretty rare, as you can tell here. I have now updated the earnings and dividends expected in September. So you can see here I've got quite a few dividends coming in. The big two are FEVR and Games Workshop. They account for about 70% of my dividends, the two of those shares. But let's talk about the ones that I've highlighted in green. So GENI is here. I haven't talked about this yet, but a few weeks ago they released what I would consider pretty good results. The share price has been really beaten up. It's sort of dropped over 80% in value, down to sort of the mid $2. It actually rallied close to $5 and then has drifted back down again. Again, I'm going to touch on these in a bit more detail in just a second in this video, but for this I've decided I'm going to sort of ride or die this one after a January investor day, where I kind of realized how the business was operating, and although there's been a lot of dilution and it's still not a profitable company, it's very close and they're meeting their targets at the moment, which I think the market was happy to see. Phoenix, so I haven't covered these guys in this video, but I do plan on delving into these a bit more. I think it's a bit of a misunderstood financial play. I would say they had a pretty decent trading update. Phoenix is one of those kind of reassuringly boring companies that is gradually making itself a bit more exciting as it moves from life insurance to wealth management. Yeah, I would say the trading update was good. They've just struck a very large deal with a Canadian insurance company, so they'll be dealing with those as a strategic partner in North America. That's their third strategic partner that they've had now. They've got Aberdeen in the UK and a Japanese company that still owns about 15% of Phoenix. So they're gradually sort of buying parts of existing companies and in the process kind of striking up relationships that are key to them growing that. So I'm very excited about it. I think it was well received by the market as well. Again, this share price ran up pretty close to what I would consider fair value. So I have a 720 fair value here. It went up to like 680 and then it's had quite a sharp pullback since then. So for me, especially if you can get this under £6, I think is a real deal. But I'm very happy to be reinvesting into Phoenix when the money comes in. So I will do more detail on Phoenix in due course. Kainos here. So I do have a reasonable stake in Kainos, close to 3% of my portfolio. It is a smallish but FTSE 250 company that deals with basically a software development house. Has two main arms. One, Workday, which is basically the main, as in Workday listed company, right, in the US. So they're the main company in the UK that basically deals with this. And then they also have a second arm, which is, customized development, typically looking at things like automation, data integrity, that kind of stuff. Hugely profitable, really impressive numbers. And although it does trade on a really hefty multiple, you're talking at like almost a 50 PE, which is pretty obscene, especially for a UK tech company. I would note that because of the speed that they're growing, their forward PE is about 30. And if you project it forward just a couple of years, they are, you get to like a forward PE in the low 20s, just because of the speed that they're growing at. And again, this is really profitable growth as well. If you look at some of their efficiency measures, they're like 20 to 30% in terms of like return on equity and things like that. It's really impressive. So we really like this one. Again, this is a small business, but it's definitely proven. And I expect this company to be in the FTSE 100 by, I don't know, about 2026, something like that, just on sort of relatively safe growth rates. So they put out a reassuring trading update that basically said it's all moving, it's going to be as expected, and nothing to worry about, and sort of highlighted the fact that both of their arms were growing sort of respectively. So again, it was well received. It was I was kind of surprised actually with this one not to see it go green. But again, considering how much the FTSE 250 was being beaten up in the tech sector as well, it was almost a result that it only dropped sort of 3%, I suppose. FEVR. So I've done a couple of videos on FEVR, and I have to say it's gradually being beaten down, but it's not unreasonably so. I've gradually become less infused as an investment when it comes to FEVR. It has historically commanded very high multiples for, I think, a very clear reason. It was basically outperforming the entire its competitors, companies like Diageo to Coca-Cola. And that was primarily because it has a very sort of capital-light model where it outsources a lot of its stuff, and it was able to grow quite quickly with a powerful brand. However, a lot of what's been highlighted now, and it's very fair basically, that this kind of capital light model also means that whereas other companies control things like bottling and things like that, they've been more able to handle increases in costs to do with production costs or bottling costs, right? The price of glass is up massively, which constitutes a very large proportion of FEVR's costs. And also for me, disappointingly, FEVR has gone from a company that was kind of the darling and really meeting its objectives to a company that's kind of a regular disappointment. It just keeps on like sort of over promising and or under delivering. So they do have kind of a recovery plan in place, but at the moment it doesn't really have the credibility. And to me, like, the revenue isn't really a problem for FEVR. It's kind of the cost controls. In the past, they were able to just pass on price increases because of the brand power. But the question is can they continue doing that with sort of cost of living challenges, etc. So it'll be interesting to see. Again, I'm still kind of optimistic on this. I'm not going to rush to sell it. But I think it's gradually become more risky. It did at one stage, it was the largest company on the AIM, FTSE AIM, so the alternative investment market. It's about fifth now after the fairly steep fall. And again, to me, it's like a company that just needs a bit more cost discipline and needs to sort of stop disappointing the market. So it has had quite a lot of analyst downgrades. I think some of them are a bit harsh. But actually, I kind of can completely agree with the bearish tones here. I no longer think this company deserves sort of a 40 PE, and realistically, at the moment, I think somewhere in sort of the 12 to 15 pounds. Maybe I need to sort of, when they put out a full earnings update, which is in the 13th of September, maybe we'll have a little look at that in a bit more detail. But for me, I'm gradually becoming more of a bear, certainly from an investment point of view, even though I still continue to love their products, by the way. Next up, we got Redrow. So this has been talked about by me a few times for various reasons. Basically, a couple of places gave the sector, as in UK house builders, a sector-wide downgrade. I'm going to be honest here, I still don't really see it. It's always like the fear is this expectation that, again, cost of living is going to mean that house prices are going to fall over. But I still don't see it. Almost all of the house builders continue to be quite upbeat. They do have earnings actually very soon in the middle of September, so we'll see how Redrow themselves are specifically done. But most of the house builders put out very reassuring both previous year and future guidance. I ultimately just believe this is kind of an economics 101 business case, right? It's like the UK house builders aren't building enough, producing enough supply. Demand keeps going up, and again, like, if you understand even basic economics, that means pricing is going to go up. And although there is some cost pressure in the house builders, they're just able to pass it on really easily. There's still a real appeal for owning your own home in the UK, and not just owning your own home. Like, there aren't enough social housing. So what's happening is, councils and local governments basically are having to subsidize private landlords to use their homes. So it's not just like the private here, they're actually using, which is its own problem, right? I mean, that shouldn't really be happening. We should be building more homes. But until we are able to build enough homes, the house prices are just going to continue going up. So for me, I think I like Redrow. It's my pick. And like I say, for me, I don't think the sector deserves to be trading on what's typically, low to mid-single digit PEs, even though they're yielding like 5 to 10%. So for me, again, I don't really see it. Like, at least when other downgrades happen, usually I can kind of understand. I might be too rosy, but again, every time housing data comes out in the UK, people seem to be surprised. Again, house prices are still up something like 11% year on year as an average. It just, so far, I'm not seeing anything that makes me believe that everything's about to fall over. So maybe I'm being contrarian here, but again, I just can't see it. Evraz, I did want to touch on this because a few people have asked me about it as somebody who's sort of bag holding. Evraz, you'll see it here, is like the fourth best performing, which tells you everything because it's frozen, so it's always 0%. I would say that from a business perspective, Evraz put out reasonably decent results, still profitable, although only just. They were also pretty combative with some of the reasons for them being sanctioned, felt it was unfair. Spoke about a few other things that, again, I'll go into detail. Highlighted the fact that regardless of what happens with sanctions, if you have shares, you remain an owner within the business, which was quite reassuring to hear. Spoke about having paper certificates as well in case they get properly delisted, which again was reassuring, even if a bit antiquated. But if that's the way we have to work around, then I think it is what it is ultimately at the end of the day. So I want to do a separate video on EVRAs and give it proper time, and realistically I'll try and do that in the next couple of weeks. I've kind of pulled everything together. I've just got a quite busy personal work life at the moment. All right, so I want to talk about Huntington Bank shares. This is a company that I find it quite hard to categorize as an investment. You've got growth, you've got value, you've got dividend. It's a little bit of everything, and it is undergoing quite a significant business transformation. Last year, it significantly expanded. This was following purchasing TCF or Torona. They did have to dilute. They sold a lot of shares to finance this, but it was broadly seen as a pretty transformational purchase. They now have presence in 11 states, and they are adding both states and capabilities as they have now fully integrated TCF. And they've also been buying a few other much smaller ones as well. The smaller additional acquisitions are really to sort of boost their cross-selling opportunities. So things like mid-market expertise, helping with sort of deal making, M&A, that kind of stuff. So that to me is quite an exciting thing to sort of see this business in transformation. Again, though, I have highlighted HBAN before. This is not a Mickey Mouse company. It's sort of a 20 billion market cap, sits in the middle of the S&P 500, and is a top 25 bank. And in America, those banks are pretty sizable. This would sort of make it one of the largest holdings in the UK. So a similar size to Legal & General, to anyone who's sort of aware. So a solid, large, profitable financial undergoing a period of transformation, but I think in a sensible way. So they highlighted, and I think this is definitely worth sharing, the TCF integration now complete. Whenever a company does, especially a large integration, there's always concerns, but they were very pleased with it. Synergies are running a quarter ahead and run over $1 billion at the moment, so extremely beneficial despite the dilution. I would say I expect this to again really help them propel them up the size moving forward. They also purchased Capstone, so this again is a sort of a wealth manager, middle market, does a lot of bookmaking, that kind of stuff. So they're really growing here as well. I would say that they're tier 1 common equity at 9.1%. So this is sort of where they're somewhat leveraged. They're sort of in the process of repairing what they have there. However, it's within the 9 to 10% range, so I consider this relatively okay. But they were mindful of the fact that they'd like it a little bit higher, and I think that's fair. Again, this is a business that has gone through quite a lot of change over the last couple of years. I want to just touch on a couple of results that I thought were really positive. It was actually quite difficult to find that much fault with them, I think. So yeah, I'll start on this one. I think this was the most important one because with regional banks, you're always mindful of the fact that you kind of have a lens on wherever the region is. So they're primarily in Ohio, but again, they're gradually sort of expanding across. But for me, I was impressed with the record low charge-offs, which as far as I can tell are basically defaults is what I would call them, and criticized loans, so basically under pressure loans, under 4%. These are both record figures, and they've reduced their guidance for what they expect of charge-offs, again, defaults. Basically, they've taken it from 0.2 to 0.15, and this is against previous financial year of 0.25. So you're basically seeing what's that 40% reduction year on year, which again to me is a good sign because it ultimately means that their customers are not having as many struggles paying. And likewise, the criticized as well. You can track that in a similar way. It's basically halved or close to halved over the same period of time. They didn't update their targets there, but again, they're very confident of staying under 4%. And I thought to me that was like reassuring that they still have that safety. They also highlighted net income from deposits, highlighted that was mixed between new customers and business customers, so consumer and business, which to me again is worth highlighting here. This isn't just consumer, it isn't just business, that you get both. And again, cross-selling as well. So like as an example, they'll pick up a business and then they'll go and pick up the CEO of that business, right? And then they'll sell them something else. And that this is kind of the way that they're expanding at the moment. So with the TCF purchase, that was about gaining scale, and the Capstone purchase is about gaining expertise. That's kind of how I would encourage you to think about it. Also reassuringly for me, and HBAN were clear that although they're mindful of the kind of economic situation, etc., so far they have 0 areas of concern within their business. They're not really seeing it. They are monitoring, so they again, they don't want to be sleeping on it, but so far they are confident with how things are going. Net interest margin here at 9.8%. I suppose this is, I don't want to dwell on this too much. Like, I think it's just reassuring. As interest rates go up, of course, banks are going to do reasonable out of it. But this is a decent margin that, again, is repairing as you would expect. More interestingly for me is the fact here that you've got non-interest income, so all positive. So cards plus 20%, capital markets plus 54%. Again, this is an area where they actively want to get into, and hence Capstone. Trust and invoice management plus 13%. So this is when you have like what I would call factoring. So you basically purchase you purchase debt effectively in the form of invoices, give sort of 90 cents to the dollar, and then your margin is basically on the assumption that you can collect the dollar. So again, positive. It's a nice way of financing, and I would call it factoring. But yeah, so I was really happy with it basically. Depending on now in terms of pricing this, I think it's an interesting one just because it's got a really hefty dividend yield. They did speak about considering share repurchases, but it didn't seem like a priority for them. For them, they think they've got a lot of like organic growth that they can pursue at the moment. I think if there is another acquisition, it's going to be similar to Capstone. I can't see them taking on a significant purchase. It'll be sort of a very expert niche provider, sort of financial advisors, wealth management, mid-market experts, those kind of bespoke businesses, basically. So that's my general direction here. So I decided here that my price target, I've had this price target for quite some time, and I still sort of feel like it's quite comfortable. Their expected EPS for the year is 134. I've decided to give them a P of 13. It is above recent sort of 5 to 10 year averages, but actually if you look over the last couple of years, it's actually below. It is a relatively volatile PE graph, so there is a little bit of arbitrary picking a number here in terms of the multiple. I mean, it's gone anywhere from like 9 to 20. I think 13 feels about right for a business that isn't mature, does have some risk. You've got the regional consideration. I do still like it though for its dividend yield as well. Like 4.5% is pretty decent, especially by American standards. And by the way, that dividend yield has gone up. The payout ratio is basically flat, a little over 50%. I'm quite happy to see 50% payout ratio, especially from a business that is still in the process of growing. Net profit here is really good and has grown as well, and I'm optimistic that will continue to grow as they sort of make some efficiency savings, close certain offices, move staff around, integrate, etc. So broadly speaking here, like all the numbers are moving really positively in the right direction. Revenue growth is really solid. You're looking at sort of 30% revenue growth. Net profit's up 25%, and again, like good numbers, like 24% net profit is extremely reasonable. I am hopeful for a dividend increase in the next quarter. We went from like 15 cents a quarter to 15.5 cents, hence 62 and 60. I think there is enough money in there to warrant another 0.5% increase, honestly. Would be good to see. But likewise, I think HBAN's main focus for the next quarter or two is going to be to get their buffer up closer to sort of 9.5% in the middle there, and basically continue to integrate and look for organic growth within that. So for me, I still like what I'm seeing in HBAN. No concern for me at all. It is, I would say, a medium risk within my profile or within my portfolio because of the regional aspect to it and the fact it is under transformation. But I'm really happy with this one, and I think it's I'm green on it by about 9%, but I would buy more. And again, I'm just going to reinvest when the dividend comes in for this as well. All right, so let's talk about Genius Sports. This is one of my few genuinely speculative investments I have left. I got into investing when SPACs were really in. Genius is absolutely a SPAC. I absolutely overpaid for Genius. I now realize they've gone through a significant period of dilution, very painful growth. However, the reason why I decided not to sell them in January when I was only down about 40%, was because I really liked their investor day. This isn't sort of a SPAC that's completely new business. They have a very profitable European arm of this, and basically the American side of it at the moment is sort of dragging everything down. But that was expected. They're more or less using money from Europe to fund growth in America, so that in a few years they'll have an American business that's bigger but otherwise looks similar than the European arm, and they're going to sort of integrate themselves in a number of ways that are quite difficult to get away from in a very cool way. I wouldn't say they have a ton of competitors. Probably Sports Radar would be the main one that I would call out. Certainly the market would agree with that assessment, I think. And so I think you can consider them peers or competitors. But broadly speaking here, Genius really delivered. For a lot of people, I think that it was surprisingly good. This is a company, like I say, still quite young, but the reason, another reason why I held on to Genius was because I actually like the management. I think they deliver reasonably good quarterly updates. When I compare it to something like GAN or DraftKings, like I think that sounds much poorer in terms of what I'm hearing, like much less organized from a board and management guidance perspective. Here, guidance was basically hit despite, I would say, a number of headwinds, mainly FX, foreign exchange. So we'll start with the EPS. So EPS is -2 cents, better than expected, significantly better than expected at -9 cents. So again, that was considered a significant win. I think Genius were pretty smart in the way that they presented their tables here. So I've literally just copied their table, which isn't normally like me, but they gave a couple of very nice, easy to use, so I just picked it up. And to me, I think the constant currency column here was the thing that raised the most eyebrows. And I mean, great. So you know, these growth figures would have been even more impressive if it wasn't for the strength of the dollar coming here. So really impressive. The media tech especially probably has some of the less variance compared to the betting technology, but even the way that they structure their deals in terms of betting technology, it's like 3 different approaches that you know, a partner can pick in order for that to structure. So there's a lot of flexibility here with sort of, you know, whether they take a long-term approach with low margins or an upfront approach, whether it's like variable and they win in the same ratio that the you know, their customers win in, or whether it's sort of more of a fixed cost. There are lots of different options. The media tech and the sports technology is sort of almost, I mean, I would kind of group them. I guess they separate them for different management. Maybe there's some nuance in terms of how it's managed internally, but ultimately here it's sort of some cool technology that underpins watching of the sports games as well. So that they've got a number of agreements. So again, I wouldn't consider them a Mickey Mouse company. And yeah, this was a real positive. So they reaffirmed all previous guidance despite the fact of these headwinds, which again was a sort of a relief to the market. This is a company that's in the process of establishing credibility effectively. And this is now the 3rd quarter in a row where, you know, after the investor day in January, they've basically done what they said they'd do and actually slightly outperformed it. So really reassuring for everybody. The reaffirmed guidance was 2022 EBITDA of 15 on 40 million revenue. EBITDA next year, exactly just as I put there, and then US profitability, so excluding the European stuff, purely the US profitability in 2024. So great, which again, it is the expectation here, and the numbers, once they do hit profitability, it scales very nicely as a business. I don't want to sort of make it like this is a no-risk investment. I mean, this is definitely still one of my riskier investments. I'm still down like 50% even after the recent jump at the moment. So dilution has definitely been very significant. This to me is one of the biggest like lessons that I've learned over the last 2 years, right? Like your share count really matters. It has such a huge impact on your EPS. And ultimately, like my stake in the business has significantly reduced as a percentage over the years. So I'm very fortunate in a way because it's my 2nd turn in Genius, and I did make like 40% the first time, although on a much smaller stake. So I guess as a net, I'm down sort of probably about 40%. But again, I decided here to sit on this one and see where we go. Yeah, I think this is exactly right. Right now, again, we're still in the process of establishing credibility. There is good progress here, but you're still looking at a significant period of risk before we start seeing a maturing business. But early signs, positive. Let's also, again, keep this in moderation. Again, I think this is a risk as well. You know, we do sometimes hear about states that seem to forever be in the process of just about to legalize and then it doesn't happen. And, you know, general appetite at the moment, sort of social, political pressures. Some people don't want to get involved in gambling. I totally understand that. It's not for everybody. And, you know, basically how they scale further will matter. Basically, you know, the company believes that it's built a very scalable platform. Oh, sorry, not built. A very scalable platform that they can sell and cross-sell, you know, and there is some cool things there. Like if you actually look at their website in terms of what the technology actually offers, and the way the content services work, it's cool. Once you sign an agreement, it's going to be extremely difficult. So I imagine that like one of the main challenges for Genius here is getting their foot in the front door. Ultimately, they have very few competitors able to do what they do. I'm against Source Radar as the main one. There are of course a couple of others. I'd include the likes of DraftKings in that as well. But there aren't a ton, and I think Genius has got a cool approach to doing it. And again, they have some great marquee names in terms of like the books that they're covering at the moment. So that's cool. I don't personally feel good publicly coming up with a number here, because honestly I feel like if I was to put a share price guess on this, it would just be like picking a number out of the air. My current average is $8, so again, for anyone who wants to have a look at the share price, you will see I'm down quite significantly. I mean 50%. So I'm hoping to get back to $9, profitable over the next couple of years. I do think this is kind of, now that I've decided to not sell, it's something I'm just going to have to strap in for. So I don't feel comfortable giving a value. I don't think I'm very good at valuing non-profitable companies. I get that it's meant to be, cost of sales and those kind of ratios, but I just I don't feel good about it. This is a company I probably wouldn't invest in today. But having put some money in it, I decided to, again, bag hold, cross my fingers, and see where we go. So, but I would say that I am encouraged by what I saw in the latest quarterly results. I think the market deservedly rewarded them. And this is also a company that kind of run up a little bit on Sports Radar results being relatively positive as well. So you sort of went from like $2 up to $5. Yeah, okay, it's now back down to $4. I think it's kind of settled around there. I'm not quite sure where we're going to go to, but I think it's probably about where it should be at the moment. And again, I think if I'm going to get back to break even here, I'm going to have to hold this for at least another 2 years and ultimately see them hopefully continue to meet, if not exceed, their guidance here. But I feel good about HBAN and Genius. I've already flagged the other ones, and I'll do my best to bring you the likes of EVRAS and FEVR that maybe are less certain, shall we say. Overall, though, I feel mentally okay when it comes to stocks. If anything, like the rest of my life at the moment has been keeping me busy. So despite the fact I've had a relatively sharp fall over the last few weeks, I feel pretty okay with it, because again, everyone's getting beaten up, and actually I only just started buying, so for me it's like great that I'm able to buy when things are a bit red. So other than that, I feel good. I'll try not to keep you waiting so long again, guys. Again, I will work on my regularity of these uploads. Otherwise, though, thank you very much for watching, everyone. I've been the Boss Hog, and good luck with your investing. Bye for now.